Hey everyone, welcome back to Corporate Decoder. In this video, we will unpack BlackRock Floating Rate Income Strategies, Fund's latest N-2 filing, a document that, between the lines, reveals how this big player is positioning itself in the investment world. And let me tell you, it is quite the read before we dive in. If you appreciate getting straight insights from corporate filings without the corporate jargon, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these documents together. Alright, so we are looking at BlackRock Floating Rate Income Strategies Fund's registration statement, basically a big announcement about their investment plans. You might know them as FRI on the New York Stock Exchange. Their main goal is to bring in a good amount of income for investors while trying to keep the capital safe by investing in floating rate debt. Think of it as investing in loans that adjust their interest payments based on market rates. They are planning to offer up to 18 million shares of common stock, which is a pretty significant chunk. This fund is a closed-end management investment company, meaning it does not continuously offer new shares like a typical mutual fund. Instead, its shares trade on the stock exchange, and their price can fluctuate above or below the actual value of the assets the fund holds, which is called net asset value or NAV. As of the 27th of October 2025, their net asset value per S-share was $12.2, but the stock was trading a little higher at $12.51, meaning it was trading at a slight premium. Historically, it has traded at both premiums and discounts, so this is something to watch. Now, let's talk about the cost of investing. The estimated annual expenses are around 2.97% of their net assets after any fee waivers. This might seem small, but over time it can really eat into your returns. For example, on a $1,000 investment, you could be looking at paying around $40 in expenses after just 1 year, and that adds up significantly over 10 years. This includes management fees, interest expenses on leverage, and other costs. Let's quickly glance at their financial highlights. For the 6 months ended the 30th of June 2025, the net investment income per share was $0.46. The net realized and unrealized gain loss was negative $0.15. Total expenses as a ratio to average net assets were 2.66%, which is pretty much in line with what they estimated. Total return based on net asset value for this period was 2.52%. This gives us a snapshot of their performance, and it looks like a mixed bag with some gains and some losses over this period. The fund aims to invest primarily in floating rate debt securities and instruments. They can use leverage, which means borrowing money to invest, potentially amplifying both gains and losses. They currently use a bank credit facility for this. They also can invest in various complex financial products like credit default swaps, total return swaps, and other derivatives for hedging or to potentially boost returns. They also invest in senior loans, corporate bonds, and even some riskier high-yield securities. Now, let's get straight to the risks because there are many. Investing in this fund is not for the faint of heart. They list a whole range of risks including credit derivatives risk, credit-linked notes risk, collateralized debt obligations risk, and investment companies and ETFs risk. They are also exposed to second lien loans risk, mezzanine securities risk, and corporate loans risk. Basically, anything that can go wrong with debt investments, they are probably covering it. A big one is reference rate replacement risk, as they mention the shift away from LIBOR and the uncertainty that comes with it. They also point out cybersecurity incidents affecting particular companies or industries could adversely affect the economies of particular countries or regions. Then there is market disruption and geopolitical risk, which covers everything from wars to trade tensions, and they specifically call out the situation in Russia and Ukraine, and trade tensions between the US and China. The fund is managed by BlackRock Advisors, LLC and Sub, advised by BlackRock International Limited. The management fee is 0.75% of net assets plus any leverage proceeds. This fee is higher when they use leverage, which is something to keep in mind. The portfolio managers include David Delbos, Mitchell S. Garfin, and Carly Wilson, all experienced professionals with backgrounds in leveraged finance and credit. The net asset value is calculated daily based on the value of the fund's portfolio securities. They use various methods to value their holdings, including closing prices for equities and dealer bid prices for fixed income securities. For securities where market quotes are not readily available, they use fair value pricing, which is an estimate and can introduce subjectivity. The fund aims to distribute income monthly, sometimes supplementing with capital gains or return of capital to maintain a level distribution. However, they do warn that a return of capital distribution can reduce your investment basis, potentially leading to future tax consequences. Ultimately, They reserve the right to change their distribution policy at any time. For us shareholders, income and gains distributed by the fund are generally taxable. If the fund fails to qualify as a regulated investment company, it could face higher taxes. Special rules apply to foreign investors, and there are potential backup withholding taxes. It is always recommended to consult a tax advisor for your specific situation. They also mention the possibility of offering subscription rights to existing shareholders to purchase more common stock. These rights can be traded, and their value depends heavily on market conditions and the subscription price relative to the fund's NAV. The shares can be offered through underwriters, dealers, agents, or directly to purchasers. The prospectus supplement will detail any specific terms, pricing, and compensation for any offering. This could involve at-the-market sales on the NICE. They will not pay compensation in the form of warrants or options, which is a good sign. They incorporate several documents by reference, including their statement of additional information, annual and semi-annual reports, and other SEC filings. This means these documents are part of the filing and contain more detailed information. This part of the filing goes into much greater detail. They explain their investment restrictions, which are quite comprehensive, including not investing more than 25% of assets in any one industry. They also discuss various investment techniques like using derivatives, mortgage-related securities, and municipal securities, each with its own set of risks. This section is crucial. BlackRock manages many accounts, and a significant portion details how they manage potential conflicts of interest. They explain how they aim for equitable treatment of all clients, but it is clear that managing multiple accounts can create situations where one client's interest might differ from another's. They mention that their portfolio managers might manage accounts with different fee structures, including those with incentive fees, which could create a financial incentive to favor those accounts. They also talk about information barriers to prevent sharing of sensitive information between different business units, aiming to ensure fair practices. BlackRock has a formal policy on how they vote proxies for the companies they invest in, delegated to BlackRock Active Investment Stewardship, or BIAs. They generally support management recommendations but will vote against them if they have concerns about how companies are serving shareholders' financial interests. They have specific guidelines for boards of directors, executive compensation, capital structure, and even sustainability considerations. They may vote against directors if boards lack independence or if compensation is not aligned with performance. Notably, they have a voting choice program for certain clients, allowing more client control over proxy voting. The filing incorporates audited financial statements for the year ended the 31st of December 2024 and unaudited statements for the 30th of June 2025. We saw some key numbers in the financial highlights table earlier, showing both investment income and some unrealized losses in the first half of 2025. Looking at the company's direction, BlackRock Floating Rate Income Strategies Fund is clearly aiming for high current income by investing in floating rate debt. Their strategy is active, meaning they're trying to pick the best investments rather than just tracking an index. The use of leverage is a key part of their strategy, which amplifies both potential gains and risks. The extensive list of risks highlights the complexity and potential volatility associated with their investment approach. The detailed conflict of interest section is also very important, as it shows how they are trying to navigate the inherent challenges of managing numerous funds with potentially competing interests. A notable opportunity for them lies in their active management style, which, if successful, could lead to outperformance. However, the significant risks associated with their investment in floating rate debt and derivatives, coupled with the use of leverage, present considerable opportunities for losses. The ongoing shift away from LIBOR also introduces a layer of uncertainty that will need careful management. Overall, this filing paints a picture of a sophisticated investment fund navigating complex markets and employing strategies that carry both significant opportunities for income generation and substantial risks. It is crucial for potential investors to understand that this is not a simple, low-risk investment. Alright, that is our breakdown of BlackRock Floating Rate Income Strategies, fund's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.